Just the other day, former U.S. President Donald Trump reignited global trade tensions, threatening a new wave of tariffs that could add pressure to already fragile supply chains and inflation outlooks worldwide. And now this morning, March inflation for the Philippines has just been released, coming in ahead of the Bangko Central's Monetary Board meeting on April 10. To help us make sense of all of these moving pieces, from global volatility to local rate paths, we're joined by Dino Aquino. He's the Vice President and Head of Fixed Income at Security Bank. Hi, Dino. Thanks for being here with us.
Thank you also for having me again.
Okay, so Dino, 1.8%, really nice benign inflation. Seems like the rate cut is baked into the cake, at least 25%. How does this development shift the policy conversation?
I think the overall dynamics, if you look at the inflation outlook, I think it's still tilted to the downside. So moving forward, even though there will be base effects in the third and fourth quarter, we're still looking at the inflation that is pretty much trending to the right direction. So that gives room for the BSP to further reduce policy rates.
How much room for this April?
This April, pretty much 25 is already baked, but I can't rule out a 50, if you ask me. Might be a possibility, who knows? But 25 is pretty much baked in already in the market.
With global risks heating up, how much room does the BSP really have to adjust monetary policy, to be dovish?
I think they have a lot of room. The concern of the market is the Fed, actually. Not just the Philippines, but everyone else is concerned if the Fed will cut rates given these tariff risks that are coming. I think the market is now in a tug of war, wherein the Fed, what will the Fed prioritize, growth or inflation? So now part of the market is looking at a huge amount of cuts. Another part of the market is looking at a pause. So that's given uncertainty to policy rates locally. But I think the Philippines has an opportunity to decouple, given the fact that we are on solid footing. Our currency is pretty much stable. Growth is stable, and our inflation benign. So all of those are supportive for the BSP to decouple.
I mean, it's in their best interest to boost consumer spending, especially with all of the risks, external risks. The Philippines isn't a major manufacturing hub. We're a net importer. So we're somewhat shielded from all of this relative. I mean, compared to our Asian peers,
like Vietnam, right?
Of course, right. But indirectly, we may feel the impact through investor sentiment and capital flows. How do you see this affecting us?
Going back to our last discussion, one of the goals of Secretary Besant is to devalue the dollar. So right now, on a year-to-date, the dollar index is down more than 6%. So that's the reason why our peso is also resilient. So if the dollar continues to devalue and our peso continues to strengthen, then our import prices will also be lower. So that will also help inflation to be benign moving forward. So I think it's not really that bad of a deal, if you ask me.
Yeah, you mentioned the peso. With BSP rate cut likely on the horizon and global volatility picking up, what's your outlook for the peso over the next couple of quarters?
I think it will stay within the range of around 56 to 58, that levels. I don't think we will go back to 60, to be honest, given that, again, Secretary Besant's goal
weakening of the U.S. dollar.
Weakening of the U.S. dollar. So it will keep the peso supported.
Okay, that's nice. Okay, so, I mean, taking a look at it, we've got benign inflation, CPI on an the BSP on an easing cycle, and the peso being supported by the weakening of the U.S. dollar. Things are looking really good for bonds.
We're on solid footing. If you recall, during our last conversation, I had a buy recommendation on the 10-year, right? That was around 6.26 at the time. Since then, we extended our duration. We even moved further down the curve, even on the 20-year. Fortunately for us, the yields have actually come down a lot, around 15 basis points since then. I think before I got on air, the 10-year is trading below 6.1. So thankfully for that. And I think there's a lot of room for it to move lower, given that the credit spreads are still very wide compared to the U.S.
And in this kind of environment, inflation easing, rate cuts on the table, Philippine bonds are much more attractive than equities. Equities haven't moved in 12 years.
I think it was that 6.1 when I entered the trust business, and it's still there, I think. So And in dollar terms, you might actually have lost a lot of money also, given that the fact that the currency was way below 50 at that time. So, but if you look at the bond market, I think it's really attractive. If you compare the spreads versus the US rates opened the year at around 4.6. It's now at 4. It's breaking at 4%. It's going to break 4%. And we're still relatively flat on a year to date. So we have widened around 60 basis points. So I think given the solid macro backdrop, we should tighten. So there's a lot of room for local bond yields to move lower.
Yeah, and bonds are interesting now because, I mean, gold's going up, but it's also very expensive. At these levels, would you say the bonds are cheap now?
Cheaper compared to gold. Gold is about
Yeah.
3,000. It's pretty expensive right now. So if you're looking for another safe haven asset, you should go to bonds.
And are we seeing renewed foreign interest in peso bonds?
Yes, I believe so. I think there's a lot of foreign interest, especially with the peso being stable. I think if the peso remains stable at these current levels, the foreign interest will continue to flow.
And in this kind of uncertain macro environment, what does it take to win in the fixed income space?
It's basically managing duration. Find value in the curve. The first time we spoke, I mentioned the 5-year because at that time the spreads were pretty flat with the 5-year and the 10-year, and it steepened. So I recommended the 10-year last time, and now it actually is still steep. So we might move a little further down.
Right. So if you were to deploy capital today, look at the longer term tenors.
Yep.
So there's the 10 and possibly 15 and 20.
Yeah, there's a 15 and the 20-year. Because the 15 and the 20-year on a year-to-date is still higher yield-wise by around 5 to 10 basis points. So that makes it cheap compared to the other tenor buckets.
And lastly, what's the best approach to navigating this kind of economic cycle with all of the Trump risk premiums at play?
Let me go back to my advice to our investors during our first interview. Time in the market is more important than timing the market. Because if you stayed in the market since January, I think you're pretty much in a good place right now.
And leave the timing to professionals like you.
Yeah, that's my job. That's
right.
what they pay me for.
All right. Thank you so much, Dino, for sharing your thoughts on fixed income and more with us this morning.
Thank you so much.